Hi, Mount Research, monthly video call, June 13th, 2023. Hey, everybody, Willie Dowitch here. Glad you have tuned in. It's time again for our slightly longer format monthly video call walk through the weight of the evidence, what we're seeing from an inflation perspective, a growth perspective, a breadth perspective, a trend perspective, lots of things to discuss today. We had inflation data this morning. We have a Fed meeting that will wrap up tomorrow, so we'll get an announcement there. Lots to discuss in terms of whether or not the Fed's going to pause or hike for the remainder of the year, what that looks like. Get into some of the mixed messages from our some of our models. We got bullish messages from the direction of the 200-day moving average. Contrast that with the percentage or the number of sectors above their 200-day averages. So really a mixed environment. Yes, we're seeing some breadth improvement beneath the surface. Yes, we're seeing more evidence of bull market behavior, but longer term trends remain a challenge. Longer term positioning remains a challenge. And so when we kind of bottom line it from a cyclical perspective, weight of the evidence still argues for caution. But from a price trend perspective, our blue heron models are max overweight equities right now. And from a tactical perspective, we're increasing equity exposure, adding to industrials, adding to South Korea. So that's the roadmap. Lots to talk about, lots to get into. Let's start with inflation. We had some data out today from a CPI perspective. That's the orange line you see here. Lots of excitement about year over year change in headline CPI dropping from around 9% about a year ago down to just slightly more than 4%. Lots of inflation's vanquished. We don't need to worry about it. Nothing to see here. We can move on. You look beneath the surface and it becomes a less clear-cut evidence of victory. Yes, when we look at median CPI on a year-over-year basis, it stopped moving higher, but it's still elevated. 6.7% is hardly something to say, okay, we can claim victory here. And I think in context to what was the Fed's biggest policy mistake of the past generation, that when they pivoted in the second half of 2019, there they were looking at headline inflation. I think they were saying, okay, well, CPI inflation's coming down. It's shy of our 2% target. They overlooked the fact that beneath the surface, median CPI was at its highest level in a decade. Look at it from a labor market perspective, and the unfilled jobs to available workers ratio was above 1. It was setting records back then, kind of like it's been setting records, higher records now, but still records. And so the takeaway here for me is, while there's a lot of hope that we can move on from inflation, I think this inflation environment that we're in now is tied directly to a premature pivot on the part of the Fed prior to COVID. And so I think they've learned the lesson of that. They're not going to be in a hurry to declare victory. They might pause, but I think it's more likely than not that at their meeting tomorrow, even if they do, forego a rate hike, and tomorrow they will signal that there's at least one more rate hike likely in the works over the second half of this year. And so giving that message to the market, that a pause now does not mean that they are done. That's the example that the Royal Bank of Australia, the Bank of Canada, they both paused and then resumed rate hikes. This inflation genie that is out of the bottle, I think, is going to take some time to get back in the bottle. It's not just a supply chain issue. It's not just the response to COVID from a kind of an M2 liquidity shock kind of messaging that people talk about a lot. It was in the works prior to COVID, and it's going to take longer to unwind. And so that likely means higher for longer, that the Fed's talked about, is likely going to be a mantra that we're going to have to deal with for quite some time. We can look at the Fed's mistake in 2019 from another perspective in terms of the Fed's balance sheet. You can see they were reducing the size of their balance sheet. They were raising rates. Then they pivoted in 2019. They cut rates. They reintroduced quantitative easing. and then balance sheet went straight vertical as the response to COVID hit. But the long and short of it is the balance sheet's still twice what it was pre pre-pandemic. There's a lot of unwind that still needs to take place. I think the Fed's going to be diligent with that. That suggests kind of this liquidity uh, headwind for stocks going forward for quite a while. It's not just, well, they're done raising rates, everything's great now. I think we need to be patient with this, and there's a cumulative effect of the rate hikes that the market needs to reckon with, and also there's this idea that rates aren't going to quickly go back to where they were prior to the surge of inflation, in large part because inflation is being slow to unwind. It's being sticky. It's not a point at this point that the Fed can declare success and move on from inflation. Likely requires rates staying higher for longer. Another way to look at the Fed's pivot in 2019, this is in terms of the 10-year T-note yield. And we briefly in the early part of 2018 moved above kind of that previous peak. The trend was changing then. Then we had some political pressures. We had kind of a self-inflicted trade war that put downward pressure on output. And then ultimately you had, the Fed caving to those political pressures and starting to cut rates. Bond market realized what was happening, so yields moved lower. Now we're moving higher again. That long-term trend, 130 some weeks of a rising trend for the 10-year T-note yield, the longest since the 60s, most sustained rise since the 60s, and starting to take out those previous highs. So definitely a different rate environment than we saw over the preceding 40 or so years. But really, it started prior to COVID. It was aborted prematurely, and then COVID hit. Now we're getting back to that environment that we were heading towards. So yields, I think, are likely to stay higher for longer than the market expects at this point. And you can see the market's been trying to prematurely pivot, anticipating a rotation on the part of the Fed. The blue line here is a 2-year T-note yield. Orange line is Fed funds rate. The Fed's been pretty consistent, pretty persistent as it's raised rates. It's been the market that has been pivoting from leading the way higher to deciding earlier this year, nope, the Fed's probably gone far enough to very briefly say, yeah, okay, well, we believe the higher for longer. Then in the wake of the bank failures and then the aborted bank crisis there, saying, nope, the Fed's likely going to have to cut. Now we're at 2-year T-note yield highest since early March. The bond market, I think, is starting to take seriously this idea that yields are going to be higher, that the Fed isn't going to be quick to pivot. 2-year hasn't caught up to where the Fed is, but it's moving in that direction, certainly more so than where we were a month or 2 months ago. And this brings us to one of our primary liquidity models, where we look at the momentum on a 6-month basis in corporate bond yields. And you can see the results, all of the gains, going back to 2000 and really prior to that, have come when BAA corporate bond yields are lower than they were 26 weeks ago. And we had this brief period earlier this year where, as yields had stopped rising, the momentum actually turned negative and was actually a tailwind for a couple months. March, April, May, for stocks that was fuel for the rally, that improved liquidity backdrop. Well, now we're seeing momentum expand again to the upside. Yields, 2-year yield I just talked about, moving higher, seeing that elsewhere. That suggests liquidity conditions beyond what the Fed is doing explicitly in terms of raising rates or other central banks are doing via raising rates. The market-based liquidity conditions are actually getting tighter as well. And so that explains why, from a weighted the evidence perspective, financial liquidity is back on the risk side. It had been down here on the bottom next to breadth and sentiment from a kind of neutral category for a couple months. Now it's back on the risk side with economic fundamentals, with valuations. On the opportunity side, we've got trends and momentum, price-based trends very strong right now. Stocks relative to bonds, stocks relative to commodities, stocks on an absolute basis. We'll get into that in a little bit when we look at our bull market behavior checklist. But trend the index level trends, that's the strength of the market right now. Breadth improving, but not enough to move it to the opportunity side. Sentiment is kind of this mixed message that we'll get into in just a moment, between increased optimism from a shorter term perspective, but positioning that never suggests that investors never really left the party. So maybe a more muted reaction as investors turn optimistic going forward. Look at this from a growth perspective. Included this in our weight of the evidence update last week, and just wanted to hit on it. Orange, that's quarterly growth in real GDP. The blue line there, that's quarterly growth in real GDI, that's gross domestic income. So we have the product side, so what's produced, versus income side, what's generated. And if you look at the last 5 quarters, 2 of them have had negative real GDP growth. You don't typically see that outside of a recession. 3 of the past 5 quarters have seen negative real income growth. Typically don't see that outside of a recession. Of the past 5 quarters, only 1 of them has seen both an expansion in GDP and gross domestic income. And so it gets to the question, why do people feel like this is a recession? Why do people talk about it as if it's a recession, even as jobs continue to be added, even as housing has stabilized a little bit? Well, it's because in aggregate, it's acting like a recession. In the economy isn't sustaining growth from a production side. It isn't sustaining growth from an income side. And so it's not fitting the NBER's definition of a recession, or at least hasn't at this point. And it's going to be hard to, as, like I said, job growth continues to take place. But beneath the surface, it there is some evidence of recession-like behavior. And you can even expand that to real retail sales haven't gone anywhere in 2 years. Real weekly earnings haven't gone anywhere since prior to COVID. Average weekly hours are declining. So there is some evidence at the edge of less than robust economic data, and that doesn't even get into what we're seeing from a manufacturing perspective, where new orders have collapsed. PMI is in the 40s. So the fundamental backdrop is not strong at this point, which adds to the Fed's challenge, because they need to deal with inflation even as we kind of muddle through some of this recession-like behavior. I think that adds to pressure on earnings. Earnings have held up well so far, but stocks are priced for perfection on an absolute basis, and they're way overpriced from a relative to where bond yields are right now. And so if we're going to kind of continue to churn higher from a price perspective, we likely need to see better than expected earnings data, and probably need to see this earnings revision trend, which has been pretty steadily rising since October, since the S&P 500 bottomed, actually continue to move higher. The challenge right now is, as you can see, it's starting to roll over. Price continues to expand. That earnings revision trend has started to roll over. So we're not seeing that kind of better than expected tailwind from an earnings perspective that we saw as stocks were moving off of those October lows. From a sentiment perspective here, this is we have our 3 primary kind of cyclical sentiment indicators here at the bottom, and then the top, that's the S&P 500. This is as of the end of last week. So the S&P 500 hadn't broken through last August highs just yet. But what we did see is a surge in exposure among active investment managers. NAIM, one of its largest weekly increases ever, moved to its highest level since November of 2021. The orangish line there, that's the II bull bear spread. That'd been steadily rising over the past couple months or so. So that was trying to get in gear. Now we have NAIM joining in the party, and individual investors as well. The AI bull bear spread went from like -7 to +20 in the course of a week. I think it's the first time in 14, 15 weeks that we've seen more bulls and bears. Only a handful of times over the past year that bulls have exceeded bears. And in one fell swoop, the bull bear spread there is highest level since November 2021. So from a cyclical sentiment perspective, we're seeing highest level since 2020, November 2021. And that, maybe think back to, well, that was right around the time that stocks were peaking. That's the backside of the sentiment cycle. It's important to remember that expanding optimism that is short of excessive optimism is a tailwind for stocks. You need bulls to have a bull market. So the expansion here from kind of a traditional perspective would be viewed quite positively, as bulls are ready to dance, as they're ready to have a party, as investors are engaged. This isn't necessarily fear of missing out. It's just, it's the optimism needed to sustain a rally. However, the challenge in that is that from a positioning perspective, we didn't really see this mass exodus of investors. The AI asset allocation survey data, equity exposure still in the 60s, still has remained above average through this whole cycle. So even though people were talking about pessimism, they weren't behaving as if they were pessimistic. From a long-term perspective, here we're looking at quarterly Fed data. That's the blue line here. And you can see this is the U.S. household asset allocation stock bond ratio. It's off its highs, but still quite elevated. So you still have this historically high tilt towards stocks and away from bonds. Why is that important? Because there's an 88% inverse correlation between that stock bond ratio and forward returns for the S&P 500. And so when that stock bond ratio is high, forward returns tend to be low. When the ratio is low, like it was a decade or so ago, coming out of the financial crisis, forward returns tend to be high. And so that's what we're showing here right now. And so you can see from a household asset allocation perspective, from a cash on the sidelines perspective, however you want to measure it from a household perspective, not some of these surveys that don't capture the whole picture, but when we look at the aggregate household data, there is still historically high levels of equity exposure, historically low levels of bond exposure, historically low levels of cash on the sidelines. And that suggests there's not this room to come rushing back into the equity market because investors are feeling better. And that I think balances some of the bullish implications of seeing this expansion in optimism. So let's look at now some of the kind of competing messages, not from a sentiment perspective, but from a price trend perspective. Here we're looking at a study on the direction of the 200-day moving average for the S&P 500. That's what you see. Orange is the S&P 500. Blue, that's the 200-day average. Down here at the bottom is if we're invested when the 200-day is rising versus if we're invested when the 200-day is falling. All of the net gains going back over nearly a quarter century have come when the 200-day moving average has been rising, and that's rising again. It had fallen briefly last week, a short-lived downturn. More about the rolling off of the August highs from there were 200 days ago. So that rolled off now. Now that's not in the calculation. Now the trend is turning higher again, and we're above those August highs. So just looking at the direction of the S&P 500's 200-day moving average, you'd say, okay, that's a bullish tailwind. But if we start to look at the sectors beneath the surface, not so clear cut. So 200-day average for the S&P 500 is rising. Only 1, 2, 3, 4 of the sectors have 200-day moving averages that are rising. Only 5 of them are even above their 200-day averages. Look at from a relative to August highs. The S&P, this is data as of the end of last week. Now the S&P is above its August highs. You only had 3 sectors that were above their August highs. You have more sectors breaking down below their December lows than you did a month ago. You have 1 fewer sector above their 200-day average now than you did a month ago. And so just with respect to the number of sectors above their 200-day averages, we're at 5 right now. And typically when you have between 2 and 8, you have this kind of muddled environment where the S&P 500, again, going back to 1999, the chart down here only goes back to 2015, just so you can see the movement there. But the table goes back to 99, which is the same as what we were showing for the S&P 500. There, it's all the gains come when it's kind of this all or nothing, where you're really oversold, and so 0 or 1 sectors are above their 200-day averages, or you're so strong that it's just very broad strength when 9 or more are above their 200-day averages. So right now it's at 5. That's not consistent with strength. That's kind of a contrasting signal from the 200-day average model for the S&P 500. Interestingly, when the 200-day moving average for the S&P 500 is rising, on average, you have 9 sectors that are above their own 200-day moving averages. Again, right now, just 5. So these mixed messages at the index level, you're seeing strength, you're seeing price action that's doing bullish things. Beneath the surface, it becomes a much more mixed environment. Indexes right now are driven by a handful of stocks, driven by a handful of sectors, and so that explains the index level strength. Can it persist? Historically, it's more of a challenge, but also historically, you haven't seen the kind of concentration that we do right now. So it's it's a mixed environment. If you want to be bullish, you look at the kind of the message from the index. If you want to be a little more cautious, you look at the message from the sectors, and try to balance them out in a disciplined way as we go forward. But if we move shorter term, the sector level trends are actually seeing some meaningful improvement. So this is kind of our short term sector model. Here we're looking at momentum, price, and breadth across the sectors. And not that long ago, we were deeply negative. Now across the board, all 3 of the indicators, all of the sectors except consumer staples and energy have positive trends at this point. So short term basis, we've got some evidence of the market getting in gear from a sector perspective. This is a kind of the visual look at it. Recall last year, the first 4 times last year. Oops, sorry about that. First 4 times last year that we kind of dipped below 0, we went on to make lower lows in terms of the S&P 500. Now, the last 3 times that kind of sector level trend indicator, I talked about being deeply negative not too long ago. Last 3 times it's got negative, we've made higher lows. So call this year what you want. We can at least acknowledge it's a different environment than we had last year. And maybe that's the takeaway. We don't need binary labels that give us a false sense of security. We can actually look at what the evidence is and adapt and adjust appropriately. And it's definitely a different environment this year than we saw last year. Some evidence of that, some hopeful evidence is, last week we just saw more new highs and new lows for first time in 14 weeks. So evidence of kind of that strength beneath the surface that we're seeing from a short-term perspective at the sector level, starting to make its way into the new highs and new lows data. Excuse me. And so that brings us to our bull market behavior checklist. A week ago, I think we're sitting at 1 out of 6. The long-term trend for the ACWI was rising, but nothing else was really behaving like a bull market. Well, sometimes a week makes all the difference in the world. Now we've got more new highs and new lows on a weekly basis. We've got our net new high advanced decline line. We'll get into that in just a moment, rising. This is still an issue. This percentage of global markets above their 50-day average, kind of some of the deterioration we've seen there, want to pay attention to. ACWI trend is still rising in the direction of the 200-day moving average for the S&P 500, moving higher again. The value line geometric index is still falling. It's been 70 weeks in a row. Still not too far from that 550 level that it's crossed 66 times or something like that in the past 5 years. So an improvement, yes. Are we? And I think we need to acknowledge that and adapt to that, certainly from a shorter term tactical perspective. That's what we're seeing here. This is our net new high advanced decline line. This 10-day trend, you can't really see it from a trend perspective. It's hard to see, 2 days of rising in data that goes back daily to 2006, but trust me, it's 2 days in a row coming into this week. And now yesterday it rose again. Today it's rising again. So it is moving higher at this point. And that's important. We had 33 days earlier this year of it rising, a brief blip last summer of it rising, but otherwise we've been in this pretty consistent environment where it's been more new lows than new highs, and that historically is not what you see when the S&P 500 is poised to move higher. So this turning higher, that's a tailwind then for the S&P 500. That turns our fear or strength model bullish. This is a tactical model. It is daily. It only stays bullish when that 10-day net new high advanced decline line is rising, or when we see the spike in the VIX. So that's the fear side of it. The strength side of it is that those net new high advanced decline line. And going back to 1990, all the net gains have come for the S&P 500 have come when this is rising. It's rising again. That's bullish, certainly from a tactical perspective. So we want to acknowledge that we can have cyclical concerns. We can have see longer term challenges, kind of secular headwinds, but from a tactical perspective, the trends are improving, and we want to lean into those trends. Another way of seeing this improvement, this changed environment this year versus last year, is what we call our quiet strength indicator. This is I've looked at this in a couple different ways, put it together this way this week. It looks at the number of days over the past week where the S&P 500 has moved less than 1% on a close to close basis, either up or down. So if the S&P has been between -1% and +1%, how many days it's done that over the past week. Add to that the number of days in the past week that new highs have exceeded new lows. You get this indicator. It shot up to 10 this week. So every day last week had more new highs and new lows. Every day the S&P 500 moved less than 1%. That's the kind of quiet strength that we typically see in bull markets. That's been missing, since the beginning of last year, late 2021. And you can see over time in these periods of sustained strength, it tends to hang out here towards the top. So you tend to in sustained in periods of sustained strength, it tends to be quiet strength, and you tend to have more new highs and new lows. The emergence of that now, after being gone for over a year, is an encouraging change in character over what we saw last year. Then we zoom out from a long-term perspective and say, yeah, we're seeing some short-term improvement, but where does that put us in terms of the long-term trend? And we still see behavior that is not inconsistent with kind of this idea of a secular bear market, this period, not where it's not secular decline, but a lengthy period of sideways. And so I think as we get caught up in, is it a bull market? Is it a bear market? We're missing the longer term perspective that a sideways market can grind for a decade, big moves higher, big moves lower, but at the end of the day, nothing is sustainable. The evidence here, this is household equity exposure as a percentage of total liquid assets. It peaked late 2021, early 2022. The previous times it peaked and moved lower, that kind of signaled the onset of this sustained period of not a lot of upside movement, lots of backing and filling from a long-term perspective. So I think that's the environment that we're in. Would make a lot of sense if we're in this environment where we need to see this broad reallocation away from equities and towards bonds. The getting there is good. Getting relatively more bonds and stocks in portfolio, that sets you up for future gains. But the getting to that point is the challenge. And we're at a point now where household equity exposure remains historically high, and is in need of some unwind. And the longer bond yields remain elevated, and look like they're going to stay elevated, I think the more likely it is that investors start to migrate in terms of fixed income exposure over time. And it's just another way of looking at that idea of secular environments from just from a price trend perspective. The green here, that's the S&P 500. The orange is all-time high. So we made new 52-week high on the S&P 500 this week. Still nowhere near an all-time high, and we're in one of the longest periods in a while without revisiting all-time highs. And so if you're an investor that came of age in the past decade, you're not used to this environment. The caveat is, if you came of age in the late 90s and experienced a lengthy decade a decade of sideways, then you're might be predisposed. And I find myself dealing with this at times personally, predisposed to seeing another secular sideways environment around every corner. So far, it's behaving more like a secular sideways than it is like the past decade, because of the length of time that has passed since the most recent new high. From an industry group trend perspective, starting to see some expansion there. That's encouraging. It's not a lot of strength, but it's at least bouncing off of support and expanding, versus what we're seeing from a global perspective, where the ACWI is making new highs. The trend there for the ACWI markets moving lower. I think it's 5 weeks in a row that has moved lower now. So seeing the indexes make new highs and the breadth measures moving lower, that's a divergence that we don't like to see. We would like to see that cleared up if breadth is actually getting in gear. Another way to look at that global breadth divergence, again, ACWI making new highs, percentage of ACWI markets above their 50-day averages down around 38%, above their 200-day averages, not even at 70%. So you're not seeing the same sort of strength beneath the surface that we saw earlier this year, late last year, as the index was starting to move higher. So what are we doing about it all? From a tactical perspective, remember, fear strength model guides a lot of the kind of the asset allocation here. As that's turned positive, we want to put cash to work. It's great to have cash on the sidelines in periods of volatility, but we also need to pull the trigger when we start to see that strength reemerge. And so adding 8% to industrials today and 7% to South Korea today, dropping the cash in this portfolio from around 39% down to about 24%. Why South Korea? This is from our relative strength rankings this weekend. EWY, that's South Korea. It's improving. It's in the top. It's making new highs. It's bullish trends, across the board. We're leaning into that strength. Industrials aren't in the top. They are rising. They're just outside of the top at this point. But from a kind of a long-term trend perspective, industrials versus tech, and we have a fair amount of tech exposure in this portfolio. If we were at a point where this ratio between industrials and tech was going to start to turn back in favor of tech and back in favor of industrials, this would be a logical spot to start to look for that. We haven't seen that trend yet, but from an absolute basis, industrials are breaking out to new highs. So following strength there, like we're following strength in South Korea. From a systematic perspective, so set the weight of the evidence aside, set breadth aside, set macro issues aside, and just looking at the price trends on an absolute basis and a relative basis, our dynamic allocation in the Blue Heron portfolio, max overweight equities, max underweight commodities, about a market weight fixed income. We've seen over the past few weeks this shift towards U.S. strength. Our macro ETF rankings, also in relative strength rankings piece, shows U.S. leadership starting to emerge. In fact, after Japan, the top, I think the top 2, 3, 4, 5 areas are U.S. areas. So that's shorter term relative strength, also being being captured in the trend matrix here. Japan is kind of capped at where its exposure can be. That's why, even though it's the strongest from a relative strength perspective, strongest from a relative trend perspective, the exposure there is not as high as Europe x UK or some of the US based exposure. So again, just from a price trend perspective, it's systematic allocation. It's max overweight stocks at this point. And while commodities are underweight, and this is what I'll leave you with today. While commodities are underweight, we don't want to forget about them as part of the conversation. I think that's so easy, especially with something like commodities. They have a period of strength and you want to get into them. We had, 2 years of commodity leadership relative to stocks, and it was commodities, commodities, commodities. Well, now they've rolled over relative to stocks. And it's easy to have them kind of slip out of the conversation, but we don't want to let that happen. If we keep in mind kind of the switching model between stocks or commodities, you can see the results there over time. This goes back to the 70s. You increase your return, you decrease your risk by having that ability to move into commodities when commodities are showing strength. And so even though they're weak right now, we want to remember that we keep them part of the conversation so that when they do get strong again, and if I'm right about inflation being a little more persistent than it's been in the past, and that probably means that commodities are poised to do well, relatively well, maybe not what they did over the last couple of years, but better than the last decade or so, where they kind of sequentially and systematically got forgotten by asset allocators. We want to keep that in our forefront so that when they do show strength again, we can move back into them. So that's the video update. Thanks for tuning in. You can download the charts, look at them all. If you got questions, feel free to reach out. And in a couple of days, we'll have our 3 for Thursday, shorter video updates, and then we'll be back again next month with this longer format video. Thanks for tuning in. Have a great rest of your week, and get outside and enjoy some summer sunshine if you're able to do that. Thanks a lot. Talk to you soon.